August 24, 1857. A bright Saturday morning in New York, the Ohio Life Insurance and Trust Company, one of America's most respected financial institutions, suddenly closed its doors. Within weeks, the entire American economy would collapse. This is the story of Wall Street's first major crisis and how it nearly destroyed the young nation. The 1850s were America's golden age. The California gold rush was pumping wealth into the economy. Railroads were expanding across the continent at incredible speed. New telegraph lines connected cities instantly for the first time. Wall Street was booming. Stock prices were climbing month after month. Banks were lending aggressively to railroad companies and land speculators. Everyone wanted a piece of America's growth story. The Ohio Life Insurance and Trust Company was at the center of it all. Based in Cincinnati but with a major office on Wall Street, they specialized in financing railroads and land development. By 1857, they held millions in loans and investments. On paper, America had never been richer, but beneath the surface, cracks were forming. Railroad companies had borrowed too much money to build too many tracks too quickly. Land prices in the West had become disconnected from reality. And banks like Ohio Life were dangerously over-leveraged. Nobody wanted to admit it, but a reckoning was coming. August 1857. Rumors start spreading on Wall Street. Ohio Life Insurance and Trust Company is in trouble. They've lost huge amounts on railroad loans that went bad. Their cashier in New York, Charles Stetson, has been embezzling funds. The company tries to deny it, but on August 24th, they can't hide anymore. Ohio Life announces they're suspending all payments. In modern terms, they're bankrupt. The news hits Wall Street like a bomb. If Ohio Life could fail, who else was in trouble? Panic spreads immediately. Investors rush to sell stocks. Depositors run to banks demanding their money. Within days, stock prices are in free fall. The railroad sector, which had driven the boom, collapses first. Companies that seemed rock-solid weeks ago are suddenly worthless. Banks across the country start failing. First in New York, then Philadelphia, then Baltimore, then everywhere. By October, over 5,000 businesses have collapsed. Unemployment spikes. Factories close. Bread lines form in major cities. The Panic of 1857 has become a full-blown depression. The panic isn't just hitting Wall Street. It's spreading across the entire country in ways nobody expected. The railroads stop expanding. Construction workers lose their jobs by the thousands. Farmers can't sell their crops because there's no credit for buyers. In New York City alone, 40,000 people are unemployed by winter. Food riots break out. Crime spikes. Desperation is everywhere. The telegraph, that miracle of modern communication, makes everything worse. Bad news travels instantly now. A bank failure in Chicago is known in New York within minutes. Panic spreads at the speed of electricity. The crisis even goes global. British banks that invested heavily in American railroads face massive losses. European investors panic and pull their money out of America. The young United States is learning a painful lesson. In an interconnected financial system, problems spread like wildfire. There's no Federal Reserve yet, no FDIC insurance, no government bailouts. Banks and businesses are completely on their own. If you fail, you fail. Simple as that. Wall Street faces an existential crisis. If the financial system completely collapses, the whole American economy goes with it. The New York banks make a desperate decision. In October 1857, they suspend specie payments. This means they stop converting paper money and deposits into gold. Technically, this is illegal, but it's the only way to stop the bank runs. If everyone tries to withdraw gold at once, every bank will fail. By suspending gold payments, they buy time. The stock exchange itself considers closing to stop the bleeding, but they decide to stay open. Closing would signal total collapse. It's better to let the market find a bottom. Some wealthy financiers try to organize buying stocks to support prices. It helps, but only a little. The panic has its own momentum now. Interestingly, the South is less affected than the North. Southern cotton exports to Europe remain strong. This will have major political consequences. Southern politicians start arguing their agricultural economy is more stable than the North's financial capitalism. This tension will contribute to the divisions leading to the Civil War just 4 years later. By early 1858, the worst is over. Banks slowly resume normal operations. Stock prices stabilize at much lower levels. But the damage is done. Thousands of businesses are gone. Millions of dollars have vanished. And Americans have learned their financial system is far more fragile than they thought. The Panic of 1857 taught America and Wall Street crucial lessons. First, interconnected financial systems create systemic risk. When one major institution fails, it can trigger a cascade. Ohio Life's collapse didn't just hurt their investors. It created a chain reaction that brought down hundreds of other firms. Second, speculation and over-leverage always end badly. The railroad boom was built on borrowed money and inflated expectations. When reality hit, the whole structure collapsed. Third, information speed matters. The telegraph made the panic worse by spreading fear instantly. In previous crises, bad news traveled slowly by mail or ship. Now it moved at light speed. Fourth, without a central bank, financial crises are harder to contain. Britain had the Bank of England to provide liquidity in crises. America had nothing. Individual banks had to fend for themselves. This debate would rage for decades until the Federal Reserve was finally created in 1913. Fifth, financial crises have political consequences. The North's economic collapse while the South stayed stable shifted political power. It emboldened Southern politicians and contributed to sectional tensions. The Panic of 1857 was a preview of patterns that would repeat. The Panic of 1873, the Panic of 1893, the Panic of 1907. Each crisis taught lessons. Each crisis was eventually forgotten, and each new generation would make similar mistakes. The Panic of 1857 was Wall Street's first real test, and it nearly failed that test completely. But the financial district survived, learned, adapted. The patterns established in 1857 are still visible today. Over-leverage leading to crisis. 2008 financial crisis. One major failure triggering a cascade. Lehman Brothers. Information spreading panic instantly. Twitter during market crashes. Debate over government intervention. Every recession. The Panic of 1857 proved that financial markets aren't just numbers on a board. They're systems that can break, with real consequences for real people. 40,000 unemployed in New York. Food riots. Families destroyed. That's what happens when Wall Street fails. From a single bank failure to a national depression in weeks. The Panic of 1857 showed America that its new financial system was powerful but fragile. Wall Street survived its first major test, but barely. The lessons learned and forgotten would shape American finance for the next century. This is Trade Origins, where every crisis teaches a lesson we eventually forget. Next time, the Civil War and Wall Street, how the North financed the war that saved the Union. Subscribe to see how war and finance became inseparable. If this story showed you a side of financial history you've never seen, hit that like button and subscribe to Trade Origins. We're documenting the crises, lessons, and patterns that keep repeating. See you in the next one.